Good morning, everyone. I'm here today to talk about Treasury Wine. It's one of my favourite topics, as you will see. This is a buy case. So people who don't own shares in Treasury Wine may argue that it's expensive. And on a PE ratio of 27 times forward earnings, superficially, they might have a case. The only problem is they would have said exactly the same thing 12 months ago. And in the meantime, the share price has doubled. Now, why? Why has it doubled? Well, because the earnings that people were forecasting 12 months ago were wrong. They were way too low. So what really is a PE ratio? It's actually the share price divided by what analysts' best guess of future earnings. But that's a very hard number, and actually mostly analysts are wrong. Now, what used to happen was that companies would get analysts in and sort of try and what was called managing expectations, i.e. this market's not going so well, or this one's doing well, and by the end of the year, the numbers were close enough to where the outcome was. But then Newcrest got fined for selective disclosure, and everything changed. You might have seen there's actually more volatility now around results because of this, because there's actually less certainty on future earnings. So I would argue, don't look at a superficial PE ratio because it's not the right number. For Treasury Wine, the return on capital has averaged only 4% post-demerger from Foster's. This is what struck me exactly a year ago when I first started looking at the company. I've been a global consumer goods analyst for over 20 years, and this number of 4% struck me as way too low. Why was it so low? The company had been formed through a series of mergers, and no one had taken the hard decisions to cut out costs and really run the business properly. Enter the new CEO, Michael Clarke, who actually joined in 2014. Now, initially he fell under the radar. I think people had very bad experience with Treasury Wine as a company and weren't really listening to what his strategy was. His aim was to change not just the strategy, but also the culture at Treasury Wine. I've met with him many times, and I think the culture side cannot be underestimated. He really had to change the culture to a marketing-led, we are a growth company. So he's in the process of transforming the business from an agricultural wine-led business to a marketing-led business. Now, as a wine consumer myself, I was concerned that the product quality might be compromised. So what I did was organised a meeting with the ex-head of marketing for Wine Australia, who happened to be a friend of mine. I actually went to university with him. And he's in contact with winemakers all over Australia. So I really dug deep on, is the quality of the wine still going to be as good if it's led by a marketing guy? And he assured me, actually, that the winemakers at Treasury were very happy and the quality was still as good as ever. So I'm sure you'll all be glad to hear that. So Michael's strategy is to take cost out of head office and the supply chain and invest a lot more in marketing behind what he calls the 15 priority brands. You'll see some of the brands listed here. On top of this change in strategy, Treasury Wine also has some structural trends in their favour. What they sell is in short supply. What I mean is the grapes in Australia is actually coming down to a low. So wine production is at a 15-year agricultural cycle, and the grape-bearing area in Australia has actually fallen 20% since the peak in 2006. But Treasury Wine has actually invested through this period and currently has $800 million of luxury wine in its inventory. This gives me confidence on future earnings growth. It also means that Treasury Wine has pricing power, which is quite unusual at the moment, as everyone knows we're in a low-growth, deflationary world. And what they sell is also in strong demand. Australian wine exports to China have doubled over the past 12 months. As a brand-led company, Treasury Wine are investing heavily in marketing, and as an example of this, have sponsored the NBA in China. And as James Halliday so eloquently put it, China is the mastodon in the room with a string of Asian elephants. And if you don't know what a mastodon is, and I didn't, it's actually a mammoth, so that's the scale that we're talking about. And then finally, the US market. Now that's the next big prize. It's actually a market where Treasury Wine has never delivered on its potential. Michael Clarke has changed the management team here and has already had some tough conversations with distributors. By buying the Diageo wine assets, Treasury Wine has gained increased clout with these distributors. So in conclusion, I think people who don't own shares in Treasury Wine might want to take another look. Thank you.
We had a bit of a discussion prior to our presentation today, and we certainly there was different views. So, Catherine, maybe you'd like to talk through your thesis. You're a seller, effectively, of Treasury Wines.
Yeah, we like the company. It meets our stock selection process. We recently sold it at $10.50. We've owned it since $7. Like I said, it meets our stock selection process, but in terms of valuation, when we do a 10-year DCF, we do have to take into account that agricultural risk that is around all wine companies. And wine companies in Australia have a habit of doing extremely well when the Aussie dollar is low at 70 cents, so like it is today. It obviously is much easier to do that, to perform well when the dollar is low, as opposed to when the dollar was, at $1.10. These companies were on their knees. So we do think that there is a cyclical element related to currency as well as the agricultural risk. So from our point of view, we think the price is pretty full, so we sold our shareholding recently.
And Neil, did you have a view?
Yeah, I think it's obviously been a great trade in Treasury Wine Estates. They've had the benefit of the falling Aussie dollar, as Catherine mentioned. They've also had the industry has gone from being an absolutely terrible industry to being a slightly less bad industry. So that's helped them. Michael Clark's come in at a good time and has done some good things, but we still don't really know too much about his performance as a manager, but he's been at the helm at a great time. And I think for those of you who are sort of Warren Buffett fans, Warren Buffett said that when you get a management team with a reputation for brilliance come up against an industry or a business with a reputation for bad economics, it's the business whose reputation remains intact. And I suspect that's what we might see when the Aussie dollar reverts and the fundamentals of the wine industry, which really is a lousy industry, reassert themselves. So I would be a seller.
Madeleine?
Right of reply. So firstly, look, as I said, I'm a global consumer analyst. I've spent most of my career overseas in the UK. I think Australians have a very poor experience with the wine industry. It's not, in fact, as bad an industry as has been run in Australia. As I said, it's a branded consumer goods industry, and if you manage those brands properly, the returns on capital should be very high. They are still very low, which is another reason why it doesn't have to be the best industry. Other companies, for example, Dominos, which I know that Neil's going to talk about, their returns on capital are over 25%. So I'm not saying it's going to be the best return on capital, it's just improving, and I think it's still got a long way to go. On the currency point, I would say this, that yes, of course, they do better when the US dollar is low in some markets, but in fact what Michael's done, he recognises both the agricultural risk and the currency risk. So he's really diversifying the source of grapes across the world now. He did the Diageo acquisition. What he wanted to do there was buy grapes in the US because he was worried about being too exposed to Australia. They already had some in the US, but he wanted more quality grapes. And so actually they're now exporting wine from the US into China. So when currency works in many ways, they've got this amazing slide in their presentation, it's very complicated, but they would argue they're actually at the moment reasonably agnostic on currency. It's not a currency play anymore. They're trying to really diversify that. They do have grapes in Italy as well, and they're supplying all over the world. So I'm not as concerned on currency as my colleagues might be here. I think it's very early days. I think to say that it's expensive is just the wrong way of looking at it. You should look at where the return on capital has been and where it's moving to, and return on capital ultimately drives earnings.
Any further comments for Catherine or Neil?
I think Madeleine made a great point when she was discussing about the reporting season that we've just had in terms of the shocks that we've had and the volatility in a lot of stocks. And your point about disclosure is right in terms of the fact that while some companies provide guidance, there's a lot of other companies that aren't spoon-feeding the analysts like they used to. So as fund managers, we have to dig deep and do even more work on those companies and make sure we're well positioned in those companies because of exactly what Madeleine was making that point about selective disclosure.
Neil?
I'd be interested to ask Madeleine her view on the distribution channels. I think one of the problems historically in many markets is you face, in the UK for example, Tesco and Sainsbury's are the dominant buyers, and so as a wine supplier you're kind of facing a Coles and Woolies situation, which as we know is a terrible place to be. Is that not one of the features of the industry globally, that you have monopolistic buyers?
No, look, it is in Australia, and again, people don't want to be too anchored on Australia. It is one of their businesses, but it's not their biggest business. And they've done an amazing job, given that is the dynamic, and they don't think that dynamic will change. So they're managing margins to improve slightly in Australia, but really they're not really going for much growth in Australia. The growth, as I said, is really going to be in China, Asia, and the US. The UK is a terrible market for them. It's a market they're not really focused on. He's actually said, it's a shame, I've got my best people in the UK, but I need to move them into Asia because that's where most of the growth is. I didn't go into too much detail, but what they did in China is actually they went to their own distribution of the product. So they did have a third-party distributor, and Michael recognised that that company wasn't doing the brands justice. And they just got best supplier to Amazon in China, which is, this is across all categories in all businesses, which I think is great indication that they're doing a good job, because Amazon would be a very hard company to supply to. And look, in the US, it's a funny system because of prohibition, believe it or not. There's actually a very funny distribution system in the US. There's what's called the three-tier system. So those conversations that he has been having with the distributors are very important to the next leg of growth. But I'm confident that with the investment, ultimately these companies want to sell brands that are growing. If they've got good brands and they're investing behind the brands, then the growth will come.
Excellent. All right, now we'd like you to vote, please. You've heard our three portfolio managers. You've buy, sell or hold, and we've heard a buy and two sell, so we'd be interested to hear your thoughts on where the securities your actions rather. Take a few moments. You're doing nothing. I'm not sure it's working. Neil, perhaps pop up there and you can tell us all about pizza. We might just have to wait till this loads up, but perhaps start if you could. Thank you.
Okay, well, I'm going to talk to you about Domino's Pizza. And to start with, I'd like to just think about how we want to invest in companies. We want to invest in great companies. So we're looking for a company in an attractive industry with good competitive advantage and a strong management team. If the clicker works, that would help. So we are looking for that, but it's also very important to get the valuation right. So we'll talk about this, but you need to make sure you've got an attractive valuation, that you've got earnings upside risk, not downside risk, and that you consider all the risks of the business, including ESG risks. I wonder if someone can turn the slides for me. Oh, there we go. Okay. Okay, so, right, here we go. Hopefully we're going to stop on this slide. So Domino's is the stock I want to talk to you about. So 10 years ago, you could have bought Domino's shares for around $3. Since then, they've gone up about 20 times, and they're now around $75, $76. So it's obviously been an incredible investment. The total shareholder return over that period has been 2,284%. That's a compound annual return of 37% per annum. And in the last 5 years in particular, we've seen the shares accelerate, and the shares have gone up 10 times for a compound annual growth rate of more than 63% per annum. So it's one of the top 3 performing stocks in the Australian market, and it really has been sensational. And I'm glad to say that we have owned the shares through much of this period. And why did we invest in Domino's originally? Well, first of all, when we look at the qualitative aspects of this business, we start off looking at industry attractiveness. So we use the classic Porter's 5 forces analysis, and it's actually quite mixed. This isn't a wonderfully attractive industry. The barriers to entry are low. There's lots of substitute products. And competitive rivalry in the takeaway pizza restaurant segment is really quite intense. However, Domino's has a couple of very important factors in its favour in its competitive position. So importantly, they have really significant scale advantages, and that drives cost efficiencies both in purchasing and through amortizing the fixed costs in the business as you drive volume through all that through the pizza network. The other factor that's really very, very strong for Domino's is their technological innovation, which they have become famous for. So they have invented features like the GPS pizza tracker, so you can watch the pizza being delivered coming to you on your phone. They have one-click ordering. They're now moving to 10-minute delivery of pizza, which is incredibly quick, and they're even experimenting with robot and drone delivery of pizzas. So they're just a few of the technological innovations which have really pushed Domino's to the forefront of their industry. The third thing that we think is really, really important is having a strong management team. And we think tenure is really important. So Don May, the CEO, and his second in charge, Andrew Rennie, have more than 30 years of tenure with Domino's. So they both started off delivering pizzas, working in the franchise shops. So they've been there an awfully long time, and we value that highly. They also have a tremendous track record. If you look at the like-for-like growth, the store rollout, the margin expansion, value-added acquisitions, they always beat guidance. They beat guidance and consensus estimates. So very, very strong track record. And finally, shareholder alignment. So they both have meaningful stakes in the business. Don May's stake in this business is about $200 million. So he's clearly very, very incentivized to optimize the shareholder value creation. So that qualitative assessment we see as very, very positive, and we've got a scoring system, and on our scoring system, Domino's scores a 0.8. That puts it right at the top end of the 300 or so companies that we do this sort of analysis for. In fact, it's 98th percentile. So in our thinking, in our framework, we definitely consider Domino's to be a great company. But a great company isn't necessarily a great investment. Valuation is key. And in the last 10 years or so, originally you could buy Domino's on a PE between 12 and 20 times. It sort of varied depending on the year. There's about 5 years, and it was in that kind of band. Roughly, the market at that time was trading at around 15 times PE, so it might have been a bit of a discount some years, a bit of a premium, but the valuation was generally acceptable. But in the last 5 years, as we saw that share price acceleration, the PE for this stock has gone from 20 times, and it's more than doubled, and it's now on 50 times 1 year forward. That makes it one of the most expensive stocks in the market, trading at about 3 times the market average PE. But of course, it's a very high growth company, and it's a bit misleading just to look at PEs for a high growth company. So what we do is a discounted cash flow valuation. And we do this for each of the major regions so that we can capture the different growth dynamics of each of the businesses. So the ANZ business still has store rollout potential, but is sort of getting closer to maturity. If you look in Europe, where they have acquired the French, Belgium, Netherlands, and most recently the German Dominos Pizza in those countries, there's still a huge amount of rollout to go, and so we factor that growth in. We also factor in extra margin expansion as the scale economies come through. And they also, a couple of years ago, acquired Japan. So we factor that in. Very low pizza consumption in Japan currently, but expected to increase. And then we also think that because they've done acquisitions on a very consistent basis, we should give them some credit for the next acquisition. We know they're looking at other things. We do think they'll do another acquisition at some point in the next 12 to 24 months. So we've kind of modeled up a potential acquisition and valued that. You see in our DCF, we're valuing it at just over $4. So when we roll all that together, we're really kind of throwing everything at our DCF. We're pushing the boat out, and we can get to $71 versus the current share price of 76. So on that basis, on a spot valuation basis, we see Domino's as being around 7% overvalued. But of course, as that PE rises, the risk rises with it, and valuation is not a static thing. There's always a range of possible outcomes. So one of the techniques we do for assessing the risk reward is using scenario analysis.
So for each of the 3 or 4 major countries, major territories, we'll look at the major value drivers for the business, which is like-for-like sales, your store rollout, and your margin. And for those key value drivers, we'll run a high and a low case, and we'll run all of that through a Monte Carlo simulation. And that gives you this distribution of potential valuations. Now you can see where the blue line is, that's Domino's current share price. To the right of that, there are some scenarios where Domino's is worth more than the current share price. But the vast majority, 95% of the scenarios, are to the downside. And that shows you your risk here. So I would argue that Domino's is priced for perfection. And for that reason, it's very, very risky. And so we have recently sold our shares. We sold just under $70 a couple of months ago. And that price perfection means that if they put a foot wrong, this is a share that could really come under huge pressure in a short space of time. So Domino's is a great company, but it's not a great investment if your valuation starting point is wrong.
Thank you, Neil. We're just going to go to our wine voting results that have come through.
Ooh.
Bye.
Good job.
I'm not sure whether that's was the alcohol on people's mind last night from what I've heard, but Madeleine, was a good pitch.
Just got there.
Thank you. All right, perhaps Catherine, you might like to start off on your thoughts on Domino's and perhaps where you're valuing it in the portfolio.
It would meet our stock selection process in terms of Domino's. It's obviously a high-quality franchise. We've got some ESG concerns around the company. I think you probably would have recently read in terms of the press articles. Domino's has benefited from underpaying its staff for many years, and what we've seen is recently in 2016 they increased the pay to delivery drivers by 9% in recognition of the fact that the company had not been paying, or the franchisees within the Domino's network had not been paying penalty rates on a Saturday and a Sunday. So we take those sort of concerns very strongly, and we actually talked to Don about them, and he readily admitted that they hadn't, under their award agreement with the union, they hadn't been paying penalty rates on a Saturday and a Sunday. And we think that the government is going to bring forward legislation in the next few months to change this, given the 7-Eleven scandal that we've seen, where franchisors are more responsible for their franchisees' behaviour. So we do think that that could potentially have an impact on the profit within the network of Australia. I think, otherwise it's a fantastic, growth company offshore, and certainly there's at least 10 PE points in the company for the management team, because they've obviously performed extremely well.
Madeleine, your thoughts?
Look, Domino's doesn't get the prize for the best pizza in my opinion, but they should get the prize for the best PR, probably in Australia. They have done an amazing job. They've understood how the market works in terms of you've got to meet or beat expectations. If you miss on expectations, then you're in trouble. And the reason why it's been, as Neil explained, re-rated and re-rated up is because they've been able to give guidance that has always been slightly lower than what they've ended up achieving, which has led to the re-rating. They've also done great PR in convincing us all that they're actually a tech company, and that's why they should trade on a high PE. Although I would argue they're not really a tech company. And in fact, there was an article in The Australian yesterday talking about an Israeli tech startup, I think it was called Dragon Tail Systems or something, that claim that compared with Domino's, they're just streaks ahead, and they're coming to Australia to sell their technology to Domino's competitors in terms of managing delivery times and production times. So they've had it all their way in Australia. They've killed the competition. And you're sort of talking about peak earnings and a peak multiple, which is a very dangerous scenario. But having said that, they are very good at managing the business clearly. And I think, you can't, as I said, the culture side is very important. You can't underestimate a team that has stayed together for a long time, that's working well. It is a very strong business, so on any weakness, it would be definitely one if they did have a hiccup that I'm sure we'd all be piling, or maybe not you because of your ESG concerns, but we would definitely have a good look at it because it is an amazing business model. But as I said as well, the returns are already very high, so not a lot of upside to go on that front.
Yeah, so I think we're all in violent agreement that at this point Domino's is a sell. But one of the real sort of investment issues has been on the run up. at what point do you sell Domino's? Because when it went from $10 to $20 in a very short space of time, which is around when they did the Japanese acquisition, a lot of people thought, well, I've just doubled my money, I should sell now. And then it ran up to $30 and it started looking expensive. I think at that time it was on around 30 times PE. And some people started selling at that point, and then it moved up to $50. It made all the way up to 70 odd bucks when it was on 50 times, which is a multiple we all struggle with. But so far, the best thing to do has been to run your winners and stick with Domino's.
What price did you buy it at, Neil?
We actually bought it around $20 after it had just doubled, which seems like a
And
strange
what sort
thing
of weighting
to do.
in the portfolio?
At that time, it was around a 2% weight. 2%
weight.
Which is quite a big position, yeah. But we recognised the value add that had come from the Japanese acquisition, and we recognised the momentum that the management team, the company had, and we were able to run it up. And by doing that detailed DCF valuation, we were able to capture some of the optionality they have in these markets like Germany, which they've just entered. And that's one of the hardest things, is to carry on holding on to something when it looks and feels expensive.
Tough decision.
Yeah, but so we did sell it recently, and it was a tough decision. I think it was the right one, though.
Very good. All right, everybody, could you please vote what your position would be, buy, sell or hold for Domino's Pizza?
Does anyone own it in the audience?
Good question, Catherine. I'm sure maybe their super fund does, potentially. That's very convincing, isn't it?
Some holders.
Now, if Dom was here, he'd all convince you to buy it.
We perhaps should have got him up.
That's probably right.
All right. Don't forget to keep sending your questions in, please, on your app. And Catherine, we'll get you up now, please, to talk about Macquarie Bank. Thank you.
Good morning. Well, having talked about two growth stocks, I was actually asked to talk about a top 20 stock. And we've just finished the reporting season, and the top 20 stocks in Australia, I'm pleased to report, have just reported minus 16% earnings growth for the FY16, which is very disappointing when you're a believer in the fact that earnings is what drives share prices over the long term. Of course, there was a cyclical element with resources, commodity prices down, but we've also seen, increased competition in the supermarket sector and low interest rates really impacting the banks and insurance companies. So I picked Macquarie Group. I see it obviously as a relative good value in what is increasingly an expensive market. So I'll just move on to the first slide. Okay, so I'm sure Macquarie Group's well known to all of you, particularly on the asset management side, which is their number one division. They actually have 6 divisions. They have 3 divisions that are annuity-style income, which is the funds management division, of which they manage approximately $480 billion, of which $70 billion is in the infrastructure, and that is really the driver of that division. It is now in the top 50 asset managers globally. Then they also have a banking and financial services group, which is predominantly here in Australia, think retail banking. And then they've also grown very successfully over the last few years a corporate and asset finance business, particularly in the US. Then they have the traditional core of Macquarie, which is really the capital market businesses. Those businesses are traditionally the investment banking businesses, equities, and also the financial markets and commodities businesses. They operate in 28 countries around the world, and in terms of what you need to know in terms of financials is there's $10 billion of revenue, and the rule at Macquarie is 40% goes to staff, 30% goes to the taxman, and 30% goes to shareholders. So that's your rough rule of thumb. Of the $4 billion that they pay to staff, about 1.6, now they don't reveal what the bonus pool is, but about 1.6 billion of that is bonus. And most of that, I would say about 70% of that 1.6 billion is at risk. So that acts as a cushion in times of when obviously we saw through the GFC that the bonus pool was rapidly reduced. So at Wavestone, I can mention that, we put all of our stocks through a qualitative filter. We have 15 factors that we look for, and we're looking for companies that have what we call superior corporate DNA. So in Macquarie's case, what we're looking at is their long-term track record. We're looking at the fact that they provide their staff opportunity, and they have a very strong risk management culture in which they're able to allow their staff to flourish and grow those businesses in logical expansion around the world. They've also got a great system, process and network in terms of what their customer engagement is, as well as their staff engagement. And they've really worked on this over the last 5 years. They've also successfully, since the GFC, reinvested in their businesses to really grow those franchises and to ensure, for example, they're the leader, number one in infrastructure globally. Now, if there's one thing that Trump and Clinton can agree on, it's the fact that they want to spend more on infrastructure. And we really think that Macquarie is very well placed to be at the heart of further infrastructure investment as governments try fiscal stimulus as a way of getting the slump of global growth moving again. We then look, like Neil was talking about in terms of Porter analysis, we look for favourable industry dynamics. And overall, Macquarie scores reasonably well with what we see as supportive government policy in terms of the infrastructure business, high barriers to entry in a lot of the businesses in which they operate in, and a reasonable business cycle. So overall, out of 15, we would give them a score of 9, which is a medium quality score for us. So one of the most important things to understand and why you would buy Macquarie today is that whole transformation that's happened since the GFC. They successfully moved their business away from those capital market-facing businesses as the main driver of their profit towards the annuity-style businesses. So what we have seen is, if you go back to the GFC, 65% of the earnings were coming from those capital market-facing businesses. The investment banking, the actual equities and commodity and financial market businesses. But now we move forward to today and 71% of their revenue is coming from the funds businesses, the corporate asset finance businesses. And as a recognition of what's happened with their business in the fact that shareholders have provided equity for them to invest in these businesses, we've actually seen a complete change in terms of the bonus pool and what Macquarie is paying its staff. So just moving, actually I'm going to move, sorry, to the staff compensation ratio to explain what's happened here. So you can see in 2007, remember what I said at the beginning, when 40% of the revenue would be paid in staff wages and bonuses, today that figure is 40%. Every 1% move in that compensation ratio is 3% to EPS. And what is not well understood is that for management to get a bonus going forward, if you look at the 2016 REM report, Macquarie has to deliver 7.5% to get 50% of that bonus allocation. So the management team have become very good at being able to keep those earnings growth expectations low in the market and to be able to drive and move those levers around to achieve that earnings over time. The other important thing that they've had to face since the GFC, like most banking businesses, is the capital headwinds. And what we've seen in terms of equity in the business, it's moved from $7 billion to $15 billion in 2016. So the return on equity in the business has halved, but from a low point in 2012 of 6%, the business has dramatically improved its return on equity. So moving on to valuation. So for DCF, we get $93 in the stock, and the stock is trading at sort of $81. The PE is about 12.5 times, which is reasonable, and the yield's 5.5%. There's some hidden logs in Macquarie as well, which you should know about. There's $5.2 billion of equity investments on their balance sheet. Within that $5.2 billion, they have a couple of interesting businesses which are worth a lot of money, which are completely being undervalued by the market. One of them is an Australian technology company called Nuix, N-U-I-X. Macquarie bought into this business and backed it with $50 million investment. That business today is valued at about $1 billion. So that is owned on the Macquarie balance sheet. It's going to be IPO'd in the next 1 to 2 years. So that is a way of hollow logging that Macquarie can meet the market expectations in terms of its earnings. They also, interestingly, have 50% of Dominos Pizza in China, which I'm not sure what that's worth, but that is also an additional hidden log within Macquarie. One of the things that I get blowback about is the performance fees that Macquarie have earned over the last couple of years. And yes, they have done extremely well from the infrastructure funds over the last couple of years in terms of their performance fees. Last year, it was about $800 million of the $10 billion in revenue was earned in terms of performance fees. But again, back to the strategy in terms of the fact that management have to achieve that 7.5% hurdle to get their bonus, they have actually cleaned up the balance sheet. They have gone through, they have impaired anything in terms of their investment portfolios, their loan portfolios in 2015 and 2016. So I think they're much better placed in terms of that $2 billion of earnings that they have enabled to grow it. The other important point is in terms of what their disclosure is. They actually only disclose what the revenue is, and then they don't actually tell you how they broke up the bonus pool between the different 6 divisions. We've had a stab at it, of course. Of the 10 billion revenue, there's 4.2 billion that they pay to their staff. Of that 4.2 billion, we estimate 1.6 billion, roughly, is paid in bonuses. Of course, in terms of the different divisions, what you pay an investment banker at Macquarie in the US and working in New York is completely different to what you pay a retail product marketing person in Australia. So, of course, the businesses that are capital market facing, we don't know after bonus and corporate allocation actually what those businesses make. But we suspect they're barely meeting their cost of capital. So when we actually look at the earnings of Macquarie, even though they say 70% of the revenue comes from the annuity business, we estimate more like 80 to 85% of the profit comes from those annuity businesses. Capital market facing businesses really, unfortunately, have been squeezed, like our industry, in terms of their margins. And so those businesses barely make their cost of capital. Sorry, and that's finally what I would like to end on, is the fact that Macquarie, I believe, is a buy.
Great, thank you. Now, Neil and Madeleine had very differing views to Catherine, so I might start with Neil first, given you're an ex-employee as well, which I might just disclose for the audience.
Yeah, I was 6 years at Macquarie. I had a great time. 6 years at Macquarie, it's fantastic. And look, I think Macquarie has been a fantastic Australian success story and a fantastic Australian export. I'm British, and all the British investment banks have long since demised, so they've done a great job. But the investment thesis really is that investment banks and trading houses trade on a PE of about 10 times, but Macquarie has transitioned itself to be a fund manager, and they trade on about 15 to 20 times. That's effectively the thesis. So at 12.5 times it's cheap because it's still getting that re-rating. The thing I would draw your attention to is that the CAF business, corporate and asset finance, it's a big chunk of that 71% of recurring revenue, and that's things like airplane leasing. Now, those businesses, I think, deserve to trade, or they do, and they deserve to trade on a low PE, because if we get any kind of GFC-style crunch, those businesses will be severely impaired, and you'll see a lot of issues in that part of the business, I believe. The other thing that you'll note from Catherine's final slide is that the return on equity for Macquarie is getting, in FY18, I think, to 14%. That's very low. It shows that the business is very capital intensive, whereas a genuine fund manager will have a very high return on equity because you really don't need, it's a people business, you don't really need a lot of capital for a genuine funds management business. So I think a P of 12.5 is probably appropriate. I certainly wouldn't be buying it here. I think any type of market correction, Macquarie is a very high beta stock, and you'll suffer from it.
I think Macquarie is probably one of the most complicated beasts in the market in a way. It's very hard to have conviction on the earnings outlook either way. And the problem I have, I really, to be honest, I don't have a strong view either way. We run a very concentrated portfolio, and companies like Macquarie, where you don't have third-party validation, they say it's recurring revenue. You don't really have a way of going and looking from not their perspective, from some other perspective, whether it is or not. So from my perspective, it falls in the actually too hard to really have conviction either way bucket, and that's why in our fund, which is we only run a 20 stock portfolio. Like Treasury Wine's actually 7% of our fund. We believe that if you're better off where you can do that sort of analysis and have high conviction to own stocks like that. But so I'm not being boring and sitting on the fence in a way. But the market clearly agrees with Neil. I mean, the correlation of Macquarie Bank shares to the market is 80%. So basically, when the market goes up, Macquarie goes up, and that's with a leverage of 1.5 times. So it's very much, to have that the market doesn't really know still how to actually analyse Macquarie's earnings. So I think it definitely just sees it as basically as a beta stock. But I'm sure Catherine's done a lot more work than I haven't, and has a lot.
In February, they agreed with the fact that the market volatility had impacted their credit market business. And when the results, but they actually issued guidance and said, no, we reiterate our group guidance for Macquarie Group. So when the result came out for that commodity and financial market business, the actual commodity and financial market business was down 31% in 2016. But yet Macquarie's group profit was up 29% to $2.063 billion. So when questioning management, you asked Nicholas Moore, what happened, and he said he was so puzzled by what happened in January and February when the market just sold the stock off from $84 down to, I think it was about 66 or something, during that market volatility period, because he said, it's the withdrawal of liquidity, right? Volatility, Macquarie make money off, right? And even with that reduction in that commodity and financial markets business, you can argue that yes, there was a 31% drop, but they still met their guidance and they still came through. And that's because the underlying annuity businesses are coming through to drive the business. So I think, like you say, I think there's more of an education process to go through with the market and their understanding of the company. But I still would argue going forward, they're very well placed in that infrastructure space.
Neil?
Yeah, I mean, you've got to remember in the GFC, Macquarie shares got down to $15 and the company would have gone bust if it was not for the bank guarantee. So Nicholas Moore did a very good job of persuading the then Treasurer to put that in place. If it had not been for that, there's no doubt Macquarie would have gone to the wall, which would have been a disaster. But that shows you that that stream of earnings in that capital markets business and some of the other asset-intensive businesses are inherently volatile.
But then that's why they've gone through the transformation. Yeah. So you've had a near-death experience.
Neil and Madeleine, you've held it in your portfolios, or you have it?
No.
No?
And we have held it in some of our but not as a very high conviction stock. And I just think it's, as Neil said, the risk on the downside is still big. So.
All right, audience, would you like to vote for us, please? Buy, sell or hold? We've just got one question. Any questions from the audience while we're just waiting for the voting to come through? Can't really see up the top there.
Lots of holds.
Just got a question here on the banks in general. So there's a bit of a hold, buy, sell.
That's a net buy.
Looks like it's more of a hold than anything for that particular stock. So we've had the three different views here on all our three securities. We've just got a question here that was asked in a previous session, but perhaps all three of you might like to comment. What is the future of the four big banks and the impact on your portfolios? Catherine?
From a share price point of view or from an earnings point of view?
Bit of both.
Okay, so I saw three of the major banks last week. And they are facing enormous revenue headwinds with this low interest rate environment in which we're in today. And that's really crimping margins, at best flat margin outlook and lower revenue growth because asset growth is coming down, because APRA has put the brakes on, particularly in mortgages. They don't mind so much in SME and business, but there is definitely lower asset growth going forward as well. So what do they have to do? They have to pull that cost lever, and it's not just about growing your costs at CPI, you actually have to get costs lower. To do that, they're going to have to spend money. So the question is, those restructuring costs are going to come through in terms of the P&Ls, probably with these results coming up. And the question is whether they take them below the line and how the market sees that. I think the outlook for them is pretty low. The question is, and the stocks bounced heavily yesterday, the question is, are we at a low point in terms of margins? And I think that's really related to what interest rates and what your view is on interest rates going forward. But at the moment, they're definitely facing earnings headwinds. And the other question that we don't know as bank investors, and that's why it's very hard to have a lot of conviction on the buy side, is what happens in terms of capital. Okay, there's two schools of thought out there. Basel IV comes through in December in terms of what the further capital requirements are going to be. But unfortunately, it looks like the Australian banks will have more capital requirements going forward because of the changes, particularly with Basel Committee classes investor housing as commercial property in terms of capital requirements, and so therefore the capital requirements in that part of banking portfolios is going to go up, and then there's also increases in terms of operational risk as well. So we will see further capital impost as well. So we're underweight in our portfolios. We own 3 of the 4 majors, and you know the outlook is pretty flat.
Madeleine?
So we run a portfolio at BlackRock which is, it's called the X5. We actually have excluded the banks and Telstra and All Resources Company, and the reasons for this is we think that in Australia there's too much concentration risk in the banks already, and everybody, because of the dividend, they've been such high dividend yields, you know, most mum and dads, we did a study basically 45% of direct funds in SMSF are in the Australian banks. And just because they've been good in the past doesn't mean they're going to be good in the future. So we've actually excluded the banks as an investment idea, because we think we can add more value to our clients elsewhere. And it's really a concentration risk, and it's a problem in the whole industry of the fact there's this index idea that we have to manage money around, whereas in fact we think no, you should buy things that you like that are going up long term and not worry about whether the banks happen to be half of the index at the moment. Although the fact that they are such a big part of the index would probably, I suggest, having looked at a lot of indexes in lots of countries around the world, mean they probably are going to be a smaller part of the index in 5 or 10 years' time.
Neil, your thoughts?
Yeah, I'll give a very quick top-down view. Here in Australia, the banks are about 30% of our stock market. In most markets around the world, it's 10%, possibly up to 15%. So why are Australian banks effectively worth twice as much as any other banks around the world? To me, they are hopelessly over-earning. We know they all gouge us something chronic. You know, it's another form of taxation, effectively. So the retail investors have been right to own the banks, but I think we're going to see their excessive monopoly profits eaten away, especially by the technical disruptors. So I think it's going to be like lots of little fish kind of nibbling away at the giant whale carcass, and I would certainly be, I'd actually be short the banks.
Good point. There was a good question here that came up on the screen before, and it's generalising on companies and board executives. So how well do all 3 of you think that companies in general are ensuring that boards and executives are acting in the best interest of their investors? I guess that'd be sort of like remuneration alignment and ESG considerations.
Me again. Okay.
We can't in any order.
Yeah, well, I mean, I think probably all fund managers, we seek to engage with boards as much as possible. We typically deal with the CEO and CFO, but increasingly we get the chairman of the board coming around and some of the independent directors, which I think is real positive. And at IFM, of course, we're active members of ACSI, and so we try and work with ACSI on company engagement on ESG issues to try and raise the overall quality and the beta of the overall market. So I think it's very important.
And active in the voting side of things?
Absolutely, yeah.
And how many per annum? Voting, you like to see?
Well, we vote all the way down through the 300 and beyond.
Yep. And you're writing to the organisations as well?
Yes, we have an active engagement program. So
Yep.
we actually, with the ISPs, for example, a couple of years ago, we had a campaign we wrote to the ISPs because there is an Interpol list of banned websites around child pornography. And Telstra and Optus had blocked these sites in line with the Interpol guidance, but the other ISPs hadn't, so TPG, IINet, for example. So we wrote to the CEO and the chairman saying that they should do this. So it's an example of the active engagement, and then we had Senator Conroy came along and helped us out by basically mandating it, which was great. But we do have that active engagement program, which I'm really happy about, actually. It's really great.
Madeleine?
It's interesting. I actually did my board of directors course. I do think Australia are probably ahead of most countries in this area, but it's really hard, the whole short-term, long-term thing. One of my most interesting meetings this year was actually with the ex-head of Aldi, the person who bought Aldi to Australia. And when they look to come into a new market, they want three things. They obviously want growth. They want all consumers to eat the same thing. So whether you're, no matter what your job is, you roughly want the same thing. And the third thing, which is the most interesting, is they want the competition to be in listed hands, because they think that it's easier to compete against listed companies than like family-owned or privately owned businesses, because listed companies are not generally run as well for the long term. So it's something that structurally we all have to, it's everybody's responsibility to think about that, because we're trying to get superannuation growth for ultimately for the ultimate shareholder, and if the businesses aren't being managed for the long term, that's not going to happen.
Your thoughts, Catherine, on alignment?
We like to see skin in the game in terms of shareholdings by the management owning the shares, just like with Domino's. But of course, like last week with Domino's, I think Don sold $9 million worth, which he said he had to buy a house in Brisbane. So I always see that as a really key sell indicator, and we run long-short funds as well as long funds, and CEO selling is such a great indicator of selling a stock. We've seen that time and time again, and we've been told that story by management. No, it's just for a house, or it's just for, a divorce. Divorce is actually very common.
Did you really buy a $9 million house?
Pardon?
Did you really buy a $9 million?
He did. Well, actually, one of the brokers did this great piece of research with the link to Domain saying, yes, there really is a house worth $9 million in Brisbane.
And he's living in it.
Pardon?
And he's living in it.
Oh, he hasn't moved yet.
Well, yeah. That'll be the proof in the pudding.
Yeah, the proof in the pudding.
We got any other questions? We're right on time here. No other burning questions? Yes, sorry, there is somebody up the top there. David, I think it is.
Been used so little. Isn't the key really long-term earnings? I mean, people talk about earnings, dividends and capital gains and that sort of stuff, but over the long term, it's really the earnings that generates the ability to have capital gains and also the ability to have earnings. I mean, shouldn't we incentivising management of these companies to just look after earnings and then say, well, the rest of it will look after itself, whereas as opposed to sort of incentives which are based on share prices and things?
Well, it comes back to what I was saying about short-term versus long-term. I mean, earnings, you can manage earnings as Woolworths did for the short term, and that ended up being for actually quite a few years, and basically they, put margins up, which was earnings growth, but ultimately it's all falling apart because they didn't invest in the business, so they didn't regenerate the stores. It was an oligopoly. A new competitor comes in, and suddenly those earnings that they were managing for, fall pretty quickly. So I think you've got to think about the long term, not just short-term earnings. So you can't just incentivise CEOs on even up to 3 years is probably too short. And it's a tenure issue. Often the CEOs, we're not as bad as America when the average tenure of a CEO is only, I think, about 3 years. I mean, at least we've got some companies that, like Domino's is a great example of long tenure leading to actually long-term earnings growth.
Neil, Catherine, any further comments?
Most of the long-term incentives seem to be based on TSR, and the short-term incentives are based on EPS growth or some sort of earnings metric. It's interesting when you get a company that's come to IPO from private equity land, where a lot of those companies have been incentivised on EBITDA, and we've had a lot of management meetings with companies that have come through that IPO process, and one of the first things we say to them is, okay, you're in the public market now, you're not in private equity land. The incentives have got to be based on an EPS basis or some sort of return on capital metric. We would like to see both, preferably. And so they really have to understand the change from being in that private, equity market where it's all about EBITDA, and move into that public market.
Yeah, I don't think you can just have earnings as a measure, because of course you can always go and buy low quality, cheap earnings and boost your earnings number.
Yeah,
so you need to have some kind of quality filter, and of course the share price in an ideal world, if we all do our jobs properly, should capture a lot of that information and tell you a lot about the quality of the earnings stream that you're owning.